The global economy is literally tearing itself apart right now. We're staring down a year defined by explosive, unprecedented technological wealth on one side and, well, profound structural fragility on the other. Welcome to the 2026 economic paradox. The data we're pulling in is, honestly, it's completely unprecedented. Factor one is a massive geopolitical supply shock. With critical global shipping lanes completely blocked off, we're looking at a nonlinear supply shock that's threatening to send crude oil absolutely rocketing toward $130 a barrel. That is going to squeeze economies worldwide. Then there's factor two, which is just absolute panic in safe haven assets. Institutional investors and central banks, they're frantically hoarding inflation-resilient assets right now. It's pushing gold way past a historic $5,000 an ounce as everybody braces for some serious, sustained volatility. And finally, factor three, the ticking clock. Despite booming equity markets and massive corporate profits, JP Morgan Global Research just officially flagged a 35% probability of a devastating global recession. Think about that for a second. That is literally a 1 in 3 chance of economic collapse. Underneath all the hype, the underlying system is flashing some very bright red warning signs. Now, before we unpack the exact forces driving these totally conflicting signals, I've got to drop a quick reminder here. This explanation is strictly for informational purposes, not financial advice. Past performance is no guarantee of future results, so absolutely make sure you're always doing your own research. Okay, let's dive into Section 1, OBBBA and the AI boom. So let's get into the engine that's actually driving the S&P 500 right toward Morgan Stanley's massive 7,800-point target. It's the incredible convergence of the artificial intelligence supercycle and the newly enacted One Big Beautiful Bill Act. Yeah, we call it OBBBA. Looking at the actual legislation driving these macroeconomic projections, impartially speaking, this bill represents an enormous fiscal impulse. The White House Council of Economic Advisors projects that these provisions, like permanently extending the Tax Cuts and Jobs Act and allowing full expensing for equipment, are going to sustain consumer spending and heavily boost business investment. For individual workers, targeted provisions like having no tax on tips and overtime are projected to save people thousands annually. But on the flip side, macroeconomic researchers over at the Brookings Institution are waving a huge red flag regarding the long-term costs. They project this legislation will jack up the federal deficit by $3.7 to $5.1 trillion over the next decade. Their warning is that higher deficits could eventually crowd out private investment entirely. Now, what's really interesting about this slide is the raw data straight from the White House's economic models. This table projects a staggering 1.3 to 3.0% boost to investment over a 10-year window. And that's just from the small business tax provisions alone. When you stack this up with the AI boom, you see corporations aggressively front-loading their capital expenditures. I mean, they are pouring money into tech infrastructure and machinery right now just to maximize these new tax efficiencies, which is completely supercharging short-term growth. And all of this creates a severe K-shaped divergence on the global stage. We're seeing sturdy U.S. GDP growth, projected somewhere between 2.6 and 2.8%. But check out the rest of the world. The euro area is trailing behind at just 1.3%, and Japan is facing a really sluggish 0.8% expansion. It's wild to see how American fiscal dominance, paired with this relentless AI capital expenditure, is just drastically outperforming other advanced markets. All right, moving on to Section 2, the global energy shock. But the U.S. fiscal engine is really only half the story here. While the U.S. runs hot, we've got massive geopolitical fractures threatening to just stall out the entire global expansion. So let's look at the bear case for a minute. The global economy is currently trying to absorb a totally nonlinear supply shock. As you know, in early 2026, peace talks collapsed, which resulted in the closure of the Strait of Hormuz. That effectively wiped out roughly 10.1 million barrels per day of crude oil from the global market. Guys, that's roughly 1/5 of the entire world's supply. And then, on April 28th, the UAE announced this completely unexpected departure from OPEC, officially leaving the cartel on May 1st. See, the UAE had invested $150 billion to expand their production capacity, and they understandably wanted to monetize those barrels. But by leaving, OPEC lost one of its very few members that actually had meaningful spare capacity. That structurally weakens the cartel's ability to stabilize prices during a crisis like this. Which leads us to Section 3. The 35% recession warning. Listen, these aren't just abstract geopolitical events happening in a vacuum.
They are tectonic shifts rattling the very foundation of the global economy. And that brings us to the single most critical, sobering data point in this entire explainer. Just look at this assessment from JP Morgan Global Research. They've officially assigned a 35% probability to a US and global recession in 2026. Now, to be fair, a recession isn't their baseline forecast. They still see a 65% chance that the economy basically muddles through. But a 35% risk? That is massive. They're citing fatal variables, like the potential for a severe energy price shock to trigger stagflation. They're looking right at that black hole in the oil supply and warning us that if inflation stays sticky or if the labor market continues to weaken, this 35% risk could rapidly become our daily reality.
Real quick, if you're finding this data-driven breakdown valuable, please hit that subscribe button right now. We are constantly analyzing these complex economic shifts to bring you clear, actionable explainers, so make sure you're subscribed to the channel. You definitely don't want to miss out on the data that actually matters. So the crucial point here is how this entire economic environment impacts you and your livelihood directly. One of the primary drivers behind that 35% recession risk is what analysts are dubbing the 2026 hiring recession. We're witnessing this wild paradox right now. AI integration is creating massive, localized productivity gains for corporations, sure, but it's simultaneously causing serious technological displacement for workers. Job growth is barely keeping pace with population increases, and unemployment is stubbornly stabilizing near 4.5%. Think about it. Because AI makes existing workers vastly more productive, the threshold for a company to actually justify hiring a brand new employee has risen significantly. So, beneath the surface, the labor market is looking incredibly fragile. All right, Section 4, Surviving the K-shaped Economy.
With the economy pulling in two completely opposite directions, we're talking massive corporate tech wealth on one side and total stagnation in the labor market on the other, how do you actually navigate this K-shaped economy? Let's break down the definitive roadmap for survival and resilience. First up, look at asset protection. The surge in inflation-resilient assets has been nothing short of historic. If we compare end of 2026 forecasts, human analysts are predicting gold will average around $5,136 an ounce, but an AI model like Copilot, it's forecasting an aggressive high end of $6,220. For silver, humans see it hitting over $80 an ounce, while AI estimates are hovering right around 78. Honestly, whether you're looking at human intuition or machine learning, this data highlights a massive, undeniable flight to safety. Big investors are aggressively bracing for tightening credit, persistent inflation, and more geopolitical shocks. And this brilliantly illustrates the exact survival strategy you need for 2026. Step 1, pay down your high-interest variable debt, and do it aggressively. If that 35% recession risk materializes and credit tightens up, you absolutely do not want to be carrying expensive debt. It's a trap. Step 2, build up those cash reserves. You are going to need a deep financial buffer to survive any potential shocks to what is, frankly, a very fragile labor market. And Step 3, upskill to become indispensable against AI. Look, recessions are exactly when companies start trimming the fat. You have to integrate AI into your workflow today so that you become the essential driver of your company's productivity, rather than a victim of technological displacement. The new economic reality of 2026 is, well, it's pretty ruthless. The middle class is shrinking, and you are either going to adapt or you're going to be left behind. The data is completely clear, the risks are elevated, and the actions you take right this second will determine exactly which side of this K-shaped economy you land on. To master the exact skills you need to become absolutely indispensable, click on our next explainer right here on the screen to learn all about AI upskilling. Go watch that right now, and I'll see you there.